All right, gang, let's get stuck in. Ed, want to start off with you on this topic of capacity planning. A lot of the firms that join us at Wize know what a capacity planner is, but typically don't have a capacity planner in place in their practice. So I want to go back to the basics here of, the fundamentals as to the importance of capacity planning, and your insights and some context to this conversation around capacity planning and why it is so important to the growth of the business. Over to you.
Sure. Thanks, Brenton. I guess if you've got to match, obviously, you've got to match your capacity with the amount of fees that you have, because if you mismatch it, then you're going to be either not profitable if you have too much capacity, and if you don't have enough capacity, then you're going to stress out all your staff. You're going to take a very long time to do the work for the clients, so you're going to get unhappy clients. So as everybody knows, the three challenges to running your business is, make sure there's enough sales or fees, make sure you've got capacity to do that work, and management of those resources that you need to do the work is important. And if you get those three right, then hopefully you'll have happy clients. So everybody's got to win. Your clients have got to win. They've got to get their work done in a timely fashion, and also, you've got to be competitive with your pricing. You're going to have happy staff, so they're not stressed out. They get paid well. And then as the shareholder, the shareholders have got to win as well. So they've got to make money and get a return on the capital that's invested in the business. So your objective is to create a win-win-win for everybody. But in order to do that, you've got to manage your business properly. And if you don't manage it, then people lose. The clients either take a long time to do their work and it's too expensive, or your staff end up being overworked or underpaid, or the shareholders don't make any money. So, but all of that comes to how you match the capacity with the workload. And of course, it's a bit of a science to do that. It's just not gut feel. And when I first started, the way that I do it is, all the staff would complain about how busy they are. They've got too much work on, so I'd just go and put on another body. So I just used to throw bodies at the workload without really knowing what I was doing. And then when I thought that I was, getting it right, then I didn't understand that, you've got to bring complementary skills in. You've got to create teams. And in that team, you have different skills. And because if you play people out of position, in other words, if you use a very high cost person who's on a very high charge out rate, doing very, very low level work, and then at the end of the job, you'll end up having to write time off, or if you charge it to the client, it becomes too expensive for the client, and then they end up leaving, and you won't be able to grow if you're too expensive, and you don't make any money, all right, because you got clients leaving. But you have to be able to put some science behind matching your capacity with the workload. So, and then of course, the low level tasks that you have in your organization, that should be done by a lower cost person. As I indicated, if you use a very high cost person to do a very low level task, then you're going to be too expensive. And so you've got to get your team structure right. So you've got to have your senior client manager with your senior production manager and the accountants underneath them. And the positions in that team structure dictates the charge out rates they're on, and the workflow and so forth. So today we're talking about capacity. So in the capacity planner, which is in the Wize vault, you can download that for your own use. It helps you put your people in the right position And then based on that position, you'll have a charge out rate. And so, for example, the managers should be checking and reviewing and training, and they're on a higher charge out rate because they're more expensive. But for them, it's about quality, not quantity. And then they have the more junior accountants working for them that's grinding out all the lower type of work at a lower cost, so that you're not only getting the right person doing the right kind of work, but you're charging them out at the right level to your clients. And then everybody wins. So the staff's getting challenged, doing work that they're at their level. So they're constantly, improving, developing, moving forward in their career. And then the more senior people are doing more high level work. So you're challenging them at a higher level work, and they're not just doing bank reconciliations or low level work. And you're challenging them at their level. So everybody wins, and hopefully you'll make some money because the people are being charged at the right charge out rates. But you need to work that out more scientifically than just gut feel, because often you get pressured by the staff to put on more people, and you have peaks and troughs in your business, as do mine. And obviously, when you're at a peak, everybody is complaining about the amount of work there is. So there's a tendency to just go and hire more bodies, and then of course the peak drops off, and now we're in the low, and then there's heaps of people around, and you're struggling to be able to find work for them, and you can't do it by just listening to people. It's got to be a lot more scientific than that. You've got to work out the numbers, and that's what we do in a capacity plan. And it's absolutely essential you do this. Otherwise, as I said earlier, you either don't make any money, or you burn your staff out, or you're too expensive, or you're too cheap. You might be too cheap to the clients. And somewhere along the line, if you don't get the science right and be a bit more scientific with the way you're running your business, then you'll pay the price.
Okay.
I hope that made sense. Yeah.
Absolutely, and we'd love to hear any questions on that from what you've just said there, Ed. But Jamie, we were talking yesterday between yourself, Ed, and I, and kind of reflecting on our own journeys in practice growth. And when you said coming into mentoring with Ed, you guys at Sky were a decent sized firm at that stage, but didn't have a capacity planner, didn't know what a capacity planner was, or didn't have the right one at least. So talk to us a bit about your journey around that, pre-capacity planner, pre-team structure, and now 6-7 years on from using that, and you've really fine-tuned that to a point now where it's a guiding pillar in the firm, and you may even walk us through a little bit of it, if you don't mind.
Yeah, that's all right. Before I met Ed, I was always, when I started my own firm, I think I spoke to peers and colleagues that were starting out and had a small firm like myself as well. It was just me and say one accountant, but I'd always was aware, Brenton, of the rule of thumb, particularly in the accounting industry, and we can talk about the bookkeeping as well, of course, but there was always this rule of thumb, a third, a third, a third. So what I mean by the third, a third, a third is of your revenue or of your turnover, a third of that would go to wages, for example. So a third of your revenue, wages, and then the second rule of thumb was a third of your revenue would go to your overheads or your expenses, and then a third of the revenue, the final third, would go to the profit. So there was this sort of rule of thumb, Brenton, from a high level context that, whatever your revenue was, if you could sort of make it, keep a third of it for profit would be a good thing. So that was really probably what I was guided by. And, prior to working with Ed around the capacity planner, I could look at, an accountant's salary, and if an account was on, 50,000 just to keep it simple, they should bill out, say 150, so that follows that rule of thumb. But when I started working with Ed, while I looked at those individual sort of KPIs of the account, as I just said, I would never forget Ed getting up on the whiteboard. Ed will remember, and going through and, asking what's people's charge out rates. And so I had to really think about that and get clarity around people's charge out rates and question, what is a charge out rate, and how is that determined? So probably frustrated Ed, but picked his brain to pieces. And then, we spoke about productivity, in our industry, and what's productivity, and, really get clarity around productivity, because between charge out rate and productivity and the number of hours a person works, this is what your capacity is per person. And while it's not an exact science, geez, it's a really good guide, particularly if you're trying to grow your firm, and you can probably manage a small team by brute force in the early days, but once you start putting on people and building teams, you've really got to have a better method than just gut feel on what people should be doing. And the capacity planner, it will show you that, that you need spare capacity. And we can talk about that, what is spare capacity? What productivity should finders and minders and grinders have as well? And yeah, so, and not only that, what's the profitability? Your single biggest cost in your firm the world over is wages. So how do you manage your wages? And the capacity planner that we work with shows you the gross profit estimate per team, and the cost of goods sold. Ed always says that the most important KPI in your entire firm. It's a great question. What is it? It's the cost of goods sold. It's the most important KPI and the biggest influence you can have. If you can get your cost of goods sold right, then you're a long way on running a profitable firm. So hopefully that gives you a bit of sort of context before I met and then and after. But back in the old days, it was that rule of thumb, a third, but then much more, I guess, scientific around the capacity planner, Brenton. So, but we can happy to work through our current capacity planner and